In September 2017, Toys R Us filed for bankruptcy. 33,000 people lost their jobs. The stores were full. The brand was still selling 1 out of every 5 toys in the United States. By every visible measure, the company was alive. What killed it had happened 12 years earlier, in a boardroom, in a deal most of those 33,000 workers never heard of. Here's what most people believe. Private equity is something that happens to big companies on Wall Street. Mergers, buyouts, financiers in suits. It has nothing to do with where you shop, where you get treated when you're sick, or what your pension holds. That belief is wrong, and the gap between what people think private equity is and what it actually does is one of the most expensive blind spots in the modern economy. So the question worth sitting with is this: how does a profitable company with a dominant market position get quietly destroyed by the people who bought it? That mechanism, the way ownership transfers risk without transferring accountability, is what this video is about. If you don't understand how it works, you'll keep misreading the news, misunderstanding your retirement fund's exposure, and missing the pattern behind a lot of economic outcomes that otherwise make no sense. My name is Alex, and if you've ever wondered why healthy companies suddenly collapse, stay with me because the explanation is more structural than most people realize, and I'm going to show you exactly how PE firms are designed to profit, and why the debt always lands somewhere else. Once you understand that, you'll stop seeing these collapses as accidents and start seeing them as outcomes. The pattern has a name. It's called an invisible empire, and it's bigger than the banking system. The invisible ownership empire. Most people think they have no relationship with private equity. That assumption is doing a lot of quiet work against them. Think about the last time you visited an urgent care clinic, renewed a lease on an apartment, or dropped your kid off at a daycare chain. There is a reasonable chance that in at least one of those moments, the company operating that business was owned by a private equity firm. Not managed by one, owned by one. Quietly, invisibly, with no sign on the door that says so. This is not a fringe phenomenon. Private equity currently manages roughly $4.4 trillion in assets in the United States alone. Global private markets, which private equity anchors, crossed $15 trillion this year. To put that in perspective, the entire U.S. commercial banking system holds around $23 trillion in assets. Private equity is not a niche corner of finance. It is a parallel financial system, operating at nearly 2/3 the scale of traditional banking, with a fraction of the public visibility. And the size has been accelerating. That $4.4 trillion figure has more than doubled since 2016. In under a decade, the industry essentially built a second version of itself. What was already large became enormous, and it did so largely outside the public conversation. Here's the part that surprises most people when they hear it. The money funding all of this is not coming from billionaires writing personal checks. Some of it is. But a significant share of the capital base behind private equity is public pension money. The retirement savings of teachers, firefighters, municipal workers, school administrators, people who spent careers in public service and are counting on a pension check in their 60s. Their fund managers, trying to hit return targets that traditional bond markets can no longer deliver, have been channeling larger and larger allocations into private equity over the past 2 decades. The logic is straightforward. Private equity has historically offered higher returns than public markets. The trade-off is liquidity, transparency, and risk. Most pension beneficiaries have no idea this is happening. Their retirement is invested in a system they have never heard explained. Take a man in his late 50s, a retired high school history teacher from Ohio. His pension fund is managed by a state board he has never met. That board, chasing the returns needed to keep the fund solvent, has allocated a portion of its capital to a private equity fund. That fund owns a chain of urgent care clinics, a portfolio of apartment buildings, and a regional home health company. He has visited one of those clinics. He rents near one of those apartment complexes. His retirement income is financially linked to the performance of companies he interacts with as a consumer, and he has no idea. That is not a conspiracy. It is just how the plumbing works. And once you see it, you cannot unsee it. Private equity-backed companies currently employ over 12 million U.S. workers, according to industry figures. The ownership may be invisible, but the footprint is not. It shows up in how companies are run, how decisions get made, and what happens when the financial structure placed on top of a business starts to put pressure on the business underneath. Which brings us to exactly how that pressure gets applied. Because the way private equity actually acquires these companies, the mechanics of the deal itself, is where the leverage concentrates, the risk transfers, and the clock starts ticking. Understanding that playbook changes how you read almost every headline about a company going under. The private equity playbook. Every industry has a model, a repeatable sequence of moves that generates returns. Private equity's version is unusually clean. 4 steps, always in the same order, always pointed at the same destination. Step 1. Raise the fund. A private equity firm goes to institutional investors, pension funds, endowments, insurance companies, and collects capital commitments into a single pooled vehicle. This fund has a fixed life, typically 10 years. The clock starts the moment the fund closes. Step 2. Acquire companies. The firm uses that capital to buy businesses, not publicly traded ones you can buy a share of through your brokerage account. Private companies or public companies that get taken private as part of the deal. The acquisition is rarely done with cash alone, but more on that in a moment. Step 3. Restructure. This is where the work happens, in theory. New leadership gets installed. Supply chains get renegotiated. Costs get cut. In some cases, the business model gets rebuilt from the ground up. The goal is to make the company more profitable, or at least more sellable within the remaining window. Step 4. Exit. Sell the company through an IPO, a sale to another firm, or a sale to another private equity fund. Return the proceeds to investors, take the performance fee, and move on. 4 moves. Clean, sequential, finite. Now, here is what most explanations of this model leave out. The fund's timeline is not a background detail. It is the central design constraint that shapes every decision made inside every company a private equity firm owns. Consider a retired logistics manager named Sandra. She spent 22 years at a regional freight company, working her way up to operations director. The company was acquired by a private equity firm in year 3 of a 10-year fund. When Sandra joined, the firm's investment committee had 7 years left before they needed to exit. Every capital expenditure, every hiring decision, and every strategic initiative was evaluated through that lens. Not, is this good for the business in 15 years? But, does this make the business more valuable before we sell it? That is a genuinely different question, and it produces genuinely different decisions. A founder building a company for the long run might invest in a new facility that takes 4 years to become profitable. A private equity owner on a 7-year clock might not. A founder might absorb a difficult year to protect the workforce. A PE firm managing toward an exit might cut headcount instead, because leaner looks better on a sale memo. Neither of these is irrational. They are just optimizing for different outcomes, over different timeframes, for different beneficiaries. This is not an argument that private equity is always wrong. It is an observation about incentives. When the timeline is fixed, the incentive is to make the business look its best at the moment of sale. Whether it actually is its best is a separate question. The other number worth holding on to here is the ownership split. Private equity acquisitions are typically funded with around 20% of the firm's own capital and around 80% in borrowed money, the same ratio as a residential mortgage. Most people hear that and think it sounds reasonable. It does on the surface. But there is one critical difference between a mortgage and a leveraged buyout. When you take out a mortgage, you owe the debt. In a leveraged buyout, the acquired company owes it. That distinction is not a footnote, it is the entire engine. And understanding the leveraged buyout engine is what separates people who follow these stories from people who actually understand them. The leveraged buyout engine. Here's the part of the story that tends to reframe everything that came before it. The 80-20 split mentioned at the end of the last section sounds familiar, because it is. You put down 20%, borrow the rest. That is how most people buy a house. And private equity firms use exactly that framing when they describe leveraged buyouts to skeptics. It is just leverage, they say. Perfectly standard financial practice. And structurally, they are right. The math is the same. But there is one detail buried in the fine print that changes the entire picture. When you take out a mortgage, you are the one who owes the bank. Your name is on the loan. If you stop making payments, your credit suffers, and you could lose the house. The risk lands on you. In a leveraged buyout, the private equity firm borrows the money, then places that debt onto the balance sheet of the company it just acquired. The firm's own finances stay clean. The acquired company is now responsible for repaying the cost of its own purchase. Read that again, because it matters. The company pays for the privilege of being bought. Walk through what that looked like with Toys R Us. In 2005, KKR, Bain Capital, and Vornado acquired the retailer for $6.6 billion. The three firms put in roughly $1.3 billion of their own capital. The remaining debt, which eventually totaled over $5 billion, landed on Toys R Us itself. The company was then required to service around $400 million a year in interest payments, not to open new stores, not to build a competitive website while Amazon was quietly eating its lunch, just to cover the cost of the debt used to acquire it. Before that deal closed, Toys R Us held $2.2 billion in cash reserves. By 2017, that figure had shrunk to $301 million. The company still controlled around 20% of all U.S. toy sales. It was not losing because it was irrelevant. It was losing because $400 million a year was leaving the business before a single strategic decision could be made. It filed for bankruptcy in September 2017. 33,000 workers lost their jobs. The private equity firms had already collected $464 million in fees and interest over the life of the investment. Now imagine a regional hospital administrator named Marcus. His hospital gets acquired in a leveraged buyout. The deal is announced as a revitalization, a capital infusion, a path to modernization. What Marcus does not see on day one is the new debt sitting on the hospital's books. What he notices 6 months later is that supply orders are getting scrutinized more carefully. The staffing model is being reviewed. Capital projects are being deferred. Each decision, in isolation, looks like normal cost management. In aggregate, it is a hospital servicing a debt it did not choose to take on, using cash that was supposed to fund operations. This is the mechanism. Not malice, not incompetence. Just math applied to an institution that was not built to carry that kind of financial weight. The house analogy the industry prefers is not wrong. It is just incomplete. The house pays its own mortgage. And if the payments become too large to manage, the people living inside find out last. What they also find out last is exactly how the firm was getting paid the entire time the clock was running, because the fee machine runs independently of whether any of this goes well. That is the next thing worth understanding. How they always profit. Before a single company gets bought, before a single deal closes, the private equity firm is already getting paid. That is not an accident. It is the design. The baseline is called 2 and 20. 2% of the total fund is charged annually as a management fee, regardless of performance. 20% of profits taken on exit, called carried interest. Those two numbers are how the industry describes its compensation structure. The 2% sounds modest until you run it against the actual fund sizes involved. A firm managing a $10 billion fund collects $200 million a year in management fees. Over the typical 10-year fund life, that is $2 billion in guaranteed revenue before a single portfolio company is sold, before a single return is delivered to investors. The fee runs on committed capital, meaning the full amount investors pledged, not just the portion actually deployed into deals. The meter starts at closing and does not stop. Blackstone, currently the largest private equity firm in the world, with over $1 trillion in assets under management, reported $5.8 billion in management and advisory fees in 2024. In the same period, realized performance revenue, the carry from actual exits, came in at $1.7 billion. The guaranteed fee was more than 3 times larger than the performance-linked pay. That ratio tells you something important about where the real business model sits. Now layer in what happens at the portfolio company level. The firm not only charges its investors, it also charges the companies it acquires. Transaction fees for executing the buyout, monitoring fees for the ongoing privilege of being owned, advisory fees for strategic guidance. These charges flow from the portfolio company back to the firm, paid out of the same operating budget the company needs to run its business. A district supply chain director named Renee spent 3 years at a mid-sized logistics company after it was acquired by a private equity firm. She described watching the quarterly fee invoices arrive from the firm's advisory arm. Not small numbers. Millions per year, billed as consulting and oversight, on top of the debt service the company was already carrying. The business was not failing. but it was running leaner than it needed to, not because of the market, not because of competition, but because a meaningful portion of its cash was leaving through fees before it could be reinvested. Then there is the dividend recapitalization. This is the move that tends to produce the strongest reaction when people first understand it. The firm instructs the acquired company to take on additional debt, not to fund growth, not to build capacity, to pay the private equity owners a special cash dividend immediately. The firm recoups its original investment while the company absorbs the new debt load. From that point forward, the firm's position is largely de-risked. If the company thrives, they collect the upside. If it struggles under the added weight, they have already gotten their money back. This is what people mean when they describe the structure as heads I win, tails you lose. It is not a moral judgment. It is just an accurate description of how the risk is distributed once a dividend recapitalization has been executed. The fee machine runs on its own track, separate from whether the underlying investment succeeds or fails. That separation matters. It is also what makes the outcomes in the next section so striking, because when you look at the real-world results of this model, the range between the best case and the worst case is not narrow. It is extreme. Successes versus failures. The fee structure described in the last section tends to make people angry. That reaction is understandable. It is also, on its own, incomplete, because the model sometimes works, not as a defense of the fees, not as a reason to overlook the structural risks, but as an honest accounting of what private equity is actually capable of when the conditions are right. The clearest example is Hilton Hotels. In July 2007, Blackstone acquired Hilton for $26 billion. Roughly $20.5 billion of that was borrowed. The timing looked catastrophic almost immediately. 18 months later, the 2008 financial crisis hit. Global travel collapsed. Hotel revenue fell sharply across the industry. The deal was widely written off. Financial press coverage at the time described it as a probable total loss. What followed was a decade of unglamorous operational work. Blackstone installed new leadership. The team expanded Hilton's international footprint, launched new mid-market hotel brands, and renegotiated the debt structure, including buying back roughly $2 billion of Hilton's own bonds at a fraction of face value during the crisis. They turned a moment of distress into a discount. When Hilton went public in December 2013, it was valued at around $20 billion. By the time Blackstone sold its final stake in 2018, the firm had generated approximately $14 billion in profit on the investment. Bloomberg described it at the time as the most profitable leveraged buyout in history. The pension funds that had backed Blackstone made money. The company survived, grew, and currently operates over 7,000 properties across 123 countries. That is the model working as intended. Capital went in, discipline was applied, and the company came out larger and more valuable than it entered. Toys R Us is the mirror image. The difference between the two outcomes is not, at its core, about effort or intention. It is about cash flow. Hilton, even during the worst hotel market in a generation, generated enough operating revenue to service its debt while being restructured. The business had the capacity to carry the weight placed on it. Toys R Us did not. $400 million a year in interest payments left no room. A retired regional store manager named Dale, who spent 19 years with the company and was let go in the 2018 liquidation, described watching the stores slowly stop refreshing their inventory displays, stop updating fixtures, stop feeling like places people wanted to spend time in. From inside the company, it looked like neglect. From the outside, it looked like a decline. What it actually was a business being drained from the top while trying to compete at the bottom. The private equity firms collected their fees throughout. When the company filed for bankruptcy in September 2017, 33,000 workers lost their jobs. The real estate was carved up and sold. The brand was eventually acquired out of bankruptcy for a fraction of its former value. 2 deals, same structure, opposite outcomes. The structure does not determine the result. The margin for error does. A business that can absorb the debt load while improving has a chance. A business that cannot is in trouble from the day the deal closes, even if nobody says so out loud. That margin question is also what regulators have been circling for years, because when the failures are large enough and frequent enough, they stop looking like isolated cases. They start looking like a pattern worth examining. And that examination is exactly where the regulatory question now stands. Regulation in the future? There is a version of this story where none of what we have covered would be a problem, because regulators would step in, require disclosure, and hold the industry accountable. That version has not happened, and the reason it has not is worth understanding on its own. Start with the scale. Global private markets currently manage around $15 trillion in assets. That figure is projected to reach $18 trillion by 2027. In the United States alone, the industry manages $4.4 trillion, a number that has more than doubled since 2016. To put that in plain terms, this is no longer an alternative asset class sitting at the edge of the financial system. It is a central pillar of it, operating at nearly two-thirds the size of traditional commercial banking, with a fraction of the regulatory oversight that banks are subject to. That gap between size and scrutiny is exactly what the SEC tried to close in August 2023. The agency passed a set of rules that would have required private fund advisors to provide investors with quarterly statements detailing fees, expenses, and fund performance. Not aggressive rules, not structural reform. Just show your investors the math. 10 months later, a federal appeals court struck them down in their entirety. The Fifth Circuit ruled unanimously that the SEC had exceeded its statutory authority. The court found that Congress had deliberately exempted private funds from certain disclosure requirements when it designed the regulatory framework, and that the SEC could not impose those requirements through rulemaking alone. The rules never took effect. That ruling places the SEC in a difficult position that has not been resolved. Without mandatory disclosure, it is harder to identify problematic fee practices. Without documented evidence of widespread harm, it is harder to justify new rules. And without new rules, the cycle repeats. The agency currently has limited tools available, and the industry knows it. The industry also knows how Washington works. In the 2023 to 2024 election cycle, private equity and investment firms directed hundreds of millions of dollars toward federal elections and political influence efforts, according to Federal Election Commission data. This is not unusual spending for the sector. What is notable is the consistency of it, year after year, on both sides of the aisle. When a court strikes down a disclosure rule, and the agency responsible for writing new ones faces sustained political headwinds, the outcome is not neutral. It is a continuation of the status quo. There is also the revolving door to consider. Former regulators take senior positions at private equity firms. Former executives move into advisory roles at government agencies. This happens across industries, but it is particularly visible in finance, where the expertise required to regulate the industry is the same expertise the industry pays well to acquire. A former SEC enforcement attorney named Patricia spent 8 years building cases against financial advisors before joining a large asset management firm as a compliance partner. She is not doing anything wrong. She is following a well-worn path, but her presence on the other side of the table is part of why structural reform moves slowly. None of this means the industry operates without any rules. It means the rules that exist are largely negotiated by people with strong incentives to keep them manageable. What it leaves open is a question that does not have a clean answer. An industry this large, touching pension funds, hospitals, housing, and employment for 12 million Americans, is making decisions that affect people who have no seat at the table and no visibility into the process. Whether that is an acceptable feature of how capitalism allocates capital or a structural problem waiting for a large enough failure to force a reckoning is something worth sitting with. How private equity actually works. Here's what this video was really about. Not a shadowy industry doing secret things. A system with clear incentives, producing predictable outcomes. Once you understand the incentives, the outcomes stop being surprising. A few things worth holding on to. Debt placed on a company is not the same as debt placed on its owner. The fee machine runs whether the investment succeeds or fails. The timeline determines the decisions, and the timeline is always pointed at the exit. Size and scrutiny do not automatically move together. The next time you hear that a company is being acquired, ask one question before anything else. Who is absorbing the debt? The answer tells you more about what happens next than any press release will. There is a related question that this video did not fully answer. Private equity has been expanding aggressively into healthcare, housing, and infrastructure over the past decade. These are not discretionary industries. People cannot simply shop elsewhere when a hospital or an apartment complex is financially restructured around an exit timeline. whether that expansion changes the risk calculus, and for whom is worth a closer look. If this changed how you read these stories, share it with someone who should be reading them differently too.